potentially we're going to have tighter credit conditions and a bigger crunch later in time. Now, conversely, if Powell does nothing, if he stands pat, that could send a very powerful signal to the market that Powell doesn't want. That would be that Powell is standing pat on interest rates and that we have seen the top in the federal funds rate. In other words, the Fed is done hiking. So if the Fed does stand pat, you can expect Jay Powell next Wednesday to be talking up his game that he could increase rates in the future or decrease them based on incoming circumstances. Now, what Powell really wants is to engineer a higher unemployment rate such that inflation comes down. And this can happen in either scenario, but it can happen in two different ways. What Powell is still trying to achieve is a soft landing, but now, because of his options, it's almost guaranteed that he's going to get a hard landing. Does he raise 25 basis points? That's going to affect the economy in one way. And if he has to admit that there is a banking panic on hand, well, what does that say about the economy and also the stock market? And if we are entering a recession, guess what? That means that the stock market has probably not made its low based on historical probabilities. I just want to show you a couple charts here. This is the probability of a 50 basis point rate hike that we are seeing evolve in the market. And let's not forget, it was only a week ago that Powell was in front of Congress and interest rates were still rising. We had this banking crisis brewing, and that probably threw some fire onto that little burning ember there. But look at these probabilities, 50 basis points, 80% all the way down to zero in a matter of days. This is a market that is very undecided of what it wants to do next because things are simply unpredictable. So with that, I send it back to you guys.
Thank you so much, Jared. Appreciate it. And obviously, this is a debate that not only the Federal Reserve is having, but the ECB is having between inflation and financial stability. And guess what? The ECB has made its decision this morning, and it's going with inflation fighting. As expected, the European Central Bank raised interest rates by 50 basis points and made a lot of comments that lead you to believe that it is targeting inflation here. The central bank saying in a statement that it is focused on inflation here. Inflation is projected to remain too high for too long, the ECB says. It says it's ready to respond on price stability and financial stability. And at the same time, the central bank is refraining from signaling future interest rate moves in its statement. This 50 basis point move by the ECB was widely telegraphed. And so there was still, unlike here in the U.S., there wasn't a lot of expectation necessarily that the ECB would move on that. And it also was given some cover, of course, by the Swiss National Bank, which came in to offer a lifeline to Credit Suisse. But still, Brad, really interesting here that you've got these two central banks with very similar issues. And the ECB is continuing on its inflation fighting path. Yeah, zeroing more on the statement from the ECB, the staff now sees inflation averaging 5.3% in 2023, 2.9% in 2024, and then 2.1% in 2025. At the same time, they're also still iterating here that the underlying price pressures remain strong. Inflation, excluding here energy and food, they continued to increase in February, and the staff expects that to average 4.6% in 2023. That is higher than foreseen in December projections there. So they're continuing to monitor some of the upward pressures from past supply shocks and the reopening of the economy fade out as tighter monetary policy increasingly dampens demand. That via the statement from the ECB this morning. Yeah, and also a reminder, inflation broadly in the Eurozone remains higher than it does here in the United States. For more on what to expect from the Fed amid this banking crisis, we welcome in Sonia Meskin, head of U.S. macro at BNY Mellon Investment Management. Thank you so much for being here. Obviously, a lot to consider. As I mentioned, we just heard from the ECB. They've made their decision. They raised 0.5%, right, at their meeting. How do you think the Fed is going to play this between sort of challenges on all sides?
Very tough situation for the Fed. Remember, rates are in absolute terms high here in the U.S. than they are in the Eurozone. The growth is also higher. I think, it used to be that their choice was tough enough between employment and inflation. And now it's between employment, financial stability, and inflation. So it's not an easy choice. I think that on the one hand, if we do get as a result of this, you guys mentioned before, small regional banks are still under pressure today. If what we get from this is a contraction in lending that leads to a contraction in U.S. growth, that will likely, at least to some extent, take care of the inflation problem for the Fed, but also likely at the risk of a recession. The data right now, we saw quite strong data for the CPI in February earlier this week. The data on the inflation front remains strong, but it's a question now how much of it is too backward looking. So I do think they go 25. Obviously, I think 50 basis points is not something that is seriously under consideration in this scenario. I do think they're more likely to raise rates than not, which will show that at least they've ring-fenced the problem on the financial stability front. But it really remains to be seen whether that's true or not.
It's not just banks that have to signal confidence to households, to businesses. It's also the Fed here still that is trying to move past its own credibility kind of crisis, if you will, coming off of 2021 and even into 2022. And so with that in mind, where do you expect the Fed's tenor to change as well, if at all?
Well, they used to say that they like to use the right tool for the right job, right? That's Bernanke's point. So use the different tools for financial stability than for monetary policy. That would be their ideal scenario. If they effectively ring-fence this problem, then